Welcome back to Primary Source China Investment. This is show T2. Peng.guo and I are happy to be back. Wanted to reach back to some of the macro numbers that have been flying around and score that with a lot of the realities that are going on in terms of the investment space, because we have the policy and we have the actual numbers that have come out. And in recent weeks, we've had a lot of long-term, well-respected investors, Chanos, Dalio, Soros. They've been equal parts China hugging and China slugging. So Peng.guo and I wanted to break down some of these macro numbers and see what the policy underlying those numbers means going forward. And the biggest headline number is GDP. So 2021, China printed an 8.1% growth. That's the fastest rate since 2012. And of course, there's a lot of volatility in there. So we wanted to put up a chart, and special thank you to the folks at Matthews China for putting this together, and my old friend Andy Rothman. So in this chart, we can see a little bit of harmonization of the growth rate because of the big spikes positively and negatively. But if you look at a compounded growth rate for 2 years, we do see pretty consistent growth. If you look a little bit closer, you do see decreasing rates of growth in 2021. Peng.guo, what are you seeing and what are you hearing on the macro GDP numbers?
I think a macro GDP number generally is used as a reference. So because it's really cover a lot of things. So if you do like the investment, so you have to get a lot of effort to narrow down how that GDP related to the area you invested.
Part of that is everybody says, oh, the numbers are baked and it's fake numbers and all this other kind of funky stuff. And definitely
they just try to see the trend. So is that a flat, is up, or is that down? If the down is that a significant or is that a minor down? So they don't really care about the exact number, they care the trend.
Yeah, when I'm looking at these numbers, exactly what you said, there's a lot underneath that. And one of the things that's come out is the consumer in China is not behaving as well as they would have expected. So it was expected that the consumer was going to step up and spending was going to increase. But actually, the number was not great. And in December was actually a negative consumption. So that's on the macro GDP side. That's a negative drag maybe for GDP growth. But one thing can be said is that China's share of global exports was on fire in 2021. Although we only have the first 3 quarters, exports rose 21% year on year in local currency in 2021, and we're up 26% compared to 2019, which was pre-pandemic. So that was a huge pull forward maybe of some demand because the pandemic brought about a lot of panic buying in a lot of sectors and industries.
Yeah.
So, this is a big push forward, but other countries are going to get back online, post-COVID. And I suspect a lot of this is going to moderate going forward.
Generally, like the consumer related, that is theoretically, that is the key for the entire economy. Unfortunately, that number, consumer capabilities always get hurt by the real estate. So people suffer about pay the mortgages and also purchase a new house. That also in turn to hurt the disposable income. That's the bigger problem. Another way is if you see like the big city, but for the up class or middle up class, their purchase power is not changing too much. It's a little bit similar like the United States. So their asset grows with the real estate and also grows with the other companies' value or the stock value. I don't think it grows too much with that. So they still have the enough purchase power to that. So China is the most important luxury product market. So it's really go to the two sides. So need to separate them to do the research.
Yeah, you brought up a great point, which is the consumption, the purchasing power, and also the real estate. So, historically, when slowdowns were happening, everybody would say, oh, Beijing's going to stimulate, 2008 and 2009, 2015, 16. There were rate cuts, leverage, accommodative policy, and it was largely focused on the real estate and construction sectors. We're seeing something very different this time. In fact, 3-month Shibor is up. Beijing is trying to de-risk property and ring fence those poor performers. So the real estate sector, China is not hitting the gas on the real estate sector. As a matter of fact, they're pulling back on the real estate sector. So that goes into the policy of, slower but better growth. I think that's the, somewhat awkward terminology that Beijing is putting forward. It's this slower but more pure or better growth going forward.
Yeah, that's right. So this is the good. It's also the good things and the bad things. The good things is the government participate in the economy, so they try to give the high level directions. So try to move the each sector to go to the right way. Some of sector need to deleverage. Some sector need to get more input to get a sustainable long-term growth. So that's a policy is very important. And also this is implementation as well as local government. That's a lot of the problem and issues in the implementation. So it could be good, it could be bad. But the market demand, if there, sooner or later, there should be some good companies grow up. And so the government is really don't know which one is good or bad. They pretty much is the bad everything. So and wait, whoever can be finalized to be the winner. Yeah. That's the strategy.
That's a cross sector, and it does look like Beijing is now willing to, make some of those or have some of those bad performers fail. In the past, it was pretty hard to have large, well-known companies fail. But now we're seeing, with Evergrande and some of these other property developers, there's going to be winners and losers, and Beijing is going to take a side. They're going to say, hey, listen, we're going to a control collapse of this company, and another company is going to step in and finish projects or make people whole or take over the assets and try to handle the liabilities. So that kind of growth is very different than in the past, where it was just pedal to the metal. We'll just have triple R cuts all day, every day. We'll have banks go out and lend. And that's not happening. So that's going to affect growth. I mean, if property is 30% of GDP, then that's still real. I mean, the consumer's more than 50%, but that, has an overlap. And the consumer's not stepping up. The consumption, like we said, has not been as fast as the overall GDP growth. So there is going to be a step down in growth, and people have to be prepared for that. And one other thing I'll say without going on too much of a rant is, peng.guo and I have talked about this. We've said GDP is not a good indication of equity returns. Look at last year as a perfect example. GDP was up more than 8%. Stock market was flat to down 2%. So it's not a good indication of where the stock market is going.
I totally agree. So you cannot use the GDP to doing like that. You can do some micro research. Another way is in China, it's very important to figure out the economic cycle. So this cycle is pretty much like 3 or 4 years, like the short-term cycle. Average is 3.5 years. And then 4 short-term cycle, combine them together, probably construct like a 14 years middle cycle. So economic, same things like the United States. So economic cycle could have conflicts or be different compared with the 2 countries. So that you will see the performance get changed or sector rotations in the investment market.
I didn't look at the valuation at this point, but like we laughed about a couple of weeks ago, nobody talks about value until the bottom falls out. So, there may be some value. And when we put the edit together for this, we'll put up some charts maybe on the valuation of the mainland and Hong Kong.
Yeah, that's true. So PE is a pretty important indicators of the major index. So we monitor that change, and you can see the PE's change. And right now is the market also know that. So that's they prepare to enter into market. So outside the capital is still, I think that right now is still okay. So they're not short of the capital in the market. They're just waiting for the right timing to enter into the market.
Right. Well, in terms of 2022, we have the Olympics going on right now. We also have the Party Congress in the fall. So we expect very few surprises through 2022. But perhaps with a general secretary for life after the fall, we'll have to navigate very closely going forward for investment opportunities in China and in renminbi.
That's true. Yeah, it's Winter Olympics open ceremony. It's gorgeous. Yeah, this is you will feel this is different from the 2008 the open ceremony. So people is more realistic. It's want to just tell the China stories. But most of the hard topic is people just evaluate the puffer jacket or long down jacket, which country's team is the best, where to buy it. You will see the Tmall, Taobao related product they get so out of stock.
Right.
Yeah, it's like the fashion show.
Exactly. Well, that's the consumer does consume. It's just what they're consuming, right?
Yeah, they do want a good product. They know which one is good or bad, so they just try to wait the right one.
Right. Well, it's a branding bonanza for a lot of the foreign and local brands.
Oh yeah, that's true. Yeah, even like the Finland. So their iceberg profit jack nobody knows before, but right now it's get well known in China.
What's the brand?
I think iceberg. Yeah.
Okay.
Yeah, the Finland brand. So
the
looks
Finnish
good.
brand.
Yeah.
I see. Yeah.
Yeah.
Well, we'll leave it at there this week. There's a lot to follow, a lot to catch up on. Thanks for tuning in to show T2, and we'll see you next week.
Thank you. See you soon.